Hello and welcome to this episode of InFocus. I'm Candis Fitch, Portfolio Manager at TriCert Investment Counsel, joined today by fellow Portfolio Manager Grayson Waechter. Good to chat with you today, Grayson.
Glad to be here.
So the resource sector, which Grayson is our researcher for, has been in the headlines a lot lately. We did hear from Brian Durno on the resulting market volatility, but could you give us a few more details on what's actually been going on?
Yeah, absolutely. So, as a response to the U.S. and Israel bombing of Iran, what they've done is gone ahead and closed the Strait of Hormuz, which is essentially a strait that is basically right by Iran. And essentially, why it's important is about 20% of the world's oil flows through that strait. If you think of the countries that are exporting, you've got, Kuwait, Iran, obviously the Arab Emirates and Saudi Arabia as well. So a lot of the oil that's exported to the eastern markets flows through the strait, and it's about 20 million barrels a day that typically goes through there.
So that's pretty significant then from a global perspective.
Yeah, absolutely. So what we've seen is just a halt in shipping altogether. With regards to maybe a few exceptions that have kind of been greenlit by Iran to be able to go through, and we're just kind of hearing news about that here and there. For the most part, all shipping has stopped. So essentially what we're seeing is no captains will go anywhere near the strait, and no insurance company will insure the boats to go near the strait. So we do hear some rhetoric from the U.S. government about sending in, the military or trying to get a coalition to kind of go in there. And I'm not a military tactician, but there's a lot of risk to do that with regards to how proximity that you are going to be to missiles and things like that. So until we get some type of safety or normality back, as well as people actually insuring the ships that are going through, it's really just ground to a halt in that area, and we've definitely seen that in the price of oil.
We've definitely seen it at the gas pumps too, I would say, from an individual perspective. We're seeing it from a consumer perspective. We're seeing it from the price of oil. What impact does this have on our core picks of the resource companies that we buy?
Yeah, absolutely. So we do have exposure to the strait. We do have our international core picks that do have some operations there. It's very negligible. So what we're seeing is the high price of oil. And right now, oil, today was around $98. It's been as high as 110. In the short term, that's offsetting any loss they might have in production that's coming out of there. So the net effect is pretty much a net gain. If you think of the bigger losers that are going to be hit more by production than necessarily the higher price, you're thinking more of like Saudi Arabia and some of those countries. But as for, our exposure with Shell and Exxon and Chevron, they've got a lot of operations diversified around the world. That's why we like them. So it's generally a net benefit to them in the short term.
Gotcha. So that sounds like semi-positive news for at least the companies that we purchase for client portfolios. I know we try to not focus on these short-term knee-jerk reactions, but more so valuations. Logically, like you said, it kind of sounds like short-term higher oil prices might be good for these guys. What does that look like in terms of overall valuation?
So what we've seen is definitely a spike in their prices. So right now they are looking quite expensive. A $98 price of oil compared to where we were just kind of a month ago when oil was trading in the low 60s is obviously a lot more. But what we like to do is we always like to look at where people are actually putting their money and what's being traded in the market. So we might have $98 oil today. But if we look at where oil is going to be and trading in the futures market out till June of next year, it's about $93. So what we are seeing is definitely a higher price of oil a year out than it was pre conflict. And we want to make sure, Brian said on the last podcast that we did, you never want to be chasing higher prices. And what we've done from a portfolio construction standpoint is we've made sure our portfolios have exposure to this. So if any geopolitical risk comes up and it does send the price of oil up, it does send the price of the stocks up. And we've seen that. We're just not necessarily going to go chase that run up, and we're going to stay disciplined in our buying approach.
Fantastic. I think that's really important too in terms of overall volatility is, we talk about the downside of volatility a lot, but there's also an upside to volatility, right? It doesn't necessarily mean always bad. And this is one of those cases where we've seen, quite a quick spike in prices due to all of this. And it's something that we like our slow and steady, very tactical approach to pricing and everything and keeping in line with what we believe the true valuation of those companies are. So that's wonderful to remind people of that. So thanks, Grayson, for all of your insights on the resource sector and what's going on with oil right now. As always, if anybody has any questions on today's topics, you can reach out to your TriCert Investment Counsel portfolio manager or your financial advisor at your accounting firm. See you next time. This podcast is provided for informational purposes only and does not constitute investment, tax, or legal advice. Any investments and/or strategies discussed may not be suitable for all listeners and should be considered based on individual investment objectives and circumstances. Listeners are encouraged to seek advice from qualified professionals before making any financial or other decisions based on the content of this podcast.